Good morning, everybody. As Stephen mentioned, my name is Joe Levin, and for most of my time as BlueStar's chief investment strategist, as I travel around the country, I focus on making a strong, compelling, pure investment case for Israel. And but for the next hour or so before we head to lunch, we're going to change things up a bit. We're going to shift gears. For what inspires us at Team BlueStar is something even greater. At BlueStar, we believe that if Israel's in your heart, or if Israel's in your philanthropic mission, then Israel should also be in your portfolio. And when Israel's in your portfolio, it's potentially a triple bottom line investment. And here's how we frame it. You've heard pieces of this before today. First and foremost, it's a solid investment, proven to be additive to performance. Second, it's good for Israel. Investing in the Israeli capital markets strengthens Israel's economy and its robust tech sector. And third, it's an active, positive response to those looking to hurt Israel economically, as investment is, in this case, the direct antidote to divestment. This session today is entitled Investing in Israel, the original mission-based investment, ? So, I'm going to begin with a question. Why are you here? Try it again. Why are you here? Why are you here as opposed to a conference on derivatives or big data, or focus on some other places around the world with similar GDP like Chile, Hong Kong, or Singapore? All which, by the way, have significantly more money tracking their broad country indexes and benchmarks than Israel. I'm guessing you're here because it just feels right. It feels right to be in the room, doesn't it? It touches something inside, and if you're anything like me, you find it intoxicating to combine your passion for Israel and your professional investment hat, and they collide in perfect harmony. With over $90 billion plus in charitable solution within Jewish communal endowments, supporting foundations, donor advised funds, etc., the imperative to align, to amplify, to connect your values and the values of your clients to their portfolios isn't just coming from the millennials or progressives, and I could say that because I'm from San Francisco. It's becoming more commonplace within the boardrooms, in the family offices, and between financial advisors and their clients. It's also at the core of BlueStar's DNA. As many of you know, BlueStar was founded back in 2010 when the Miami Jewish Federation looked under the hood of their endowment and asked, how much Israel do we have in our portfolio? Shouldn't our communal investments align with our mission and our values? As an aside, how many of you, by raise of hands, sit on a board of a charity, Jewish or non-Jewish, or on an investment committee of an organization? Okay. I want to challenge all of us. I want to challenge us to think about philanthropic assets or assets sitting in endowments as simply grant dollars in waiting, dollars that are going to support that organization's mission. And if you accept this premise, and I realize it's a slightly different mindset, then why limit your impact to 5% or whatever your spending guideline may be, when you can tap into a greater portion of the other 95% and unlock even a greater impact? You know, under the guidance of now CIO Alon Ozer, who you heard earlier from Miami, I think he's still in the room, BlueStar created an institutional quality index-based exposure for Israel for the Miami Jewish Federation's portfolio endowment. So Alon, thank you for your vision and your partnership and pushing us to create what is now BlueStar. The Jewish United Fund of Chicago shortly followed, And I'm happy to report that ETFs that track BlueStar's indexes are proudly in the portfolios of federations and foundations across the country, from Metro West New Jersey to Memphis and Colorado, and that's just to name a few. And one of these organizations is the Jewish Communal Fund of New York City. And here to help kick off our session, I'd like to introduce Zoya Raynes to say a few words. Now, Zoya is the global head of marketing and investor relations at Amber Capital, and she's very active in the nonprofit and philanthropic community. It's both extensive and impressive, her resume. And most notably, Zoya is the current president of the Jewish Communal Fund. Please welcome Zoya.
Good morning. Thank you for inviting me here to share information about the Jewish Communal Fund. JCF is the donor-advised fund for the New York Jewish community and is the largest and most active network of Jewish funders. We have a 46-year track record and currently manage over $1.6 billion in charitable assets for over 3,500 funds. Last year, JCF distributed close to $400 million in grants on behalf of our donors to thousands of charities, both here in the US and in Israel. Additionally, by choosing JCF to facilitate your charitable giving, you further enable us to support local Jewish programs and initiatives from our endowment, the Special Gifts Fund, and change lives for the better, creating both the double and the triple bottom line with your philanthropic dollars. As JCF is a public charity, the tax deduction for your contribution is higher than if you used a private foundation. A gift to JCF qualifies for an immediate tax deduction, and you can decide later where to donate from and to. JCF helps eliminate all of the record-keeping and administrative hassles that's typically associated with charitable giving. More than just being a charitable, efficient giving vehicle, our donors can invest their charitable assets so they can grow even further over time, tax-free. We offer a robust investment platform and several alternative investment options for funds over $500,000. Those with funds over $1 million may suggest an investment manager to be added to our platform after it is vetted by our independent investment counsel. We are very proud to offer donors investment options that align with their philanthropic mission. Our investment platform features the Van Eck Vectors Israel ETF, ISRA, which tracks the BlueStar Israel Global Index. We also offer the opportunity for our fund holders to invest in Israel bonds. At JCF, we're continuing to add value to our fund holders, and in the near future, we'll be enhancing our investment platform with further mission-aligned investment options and offering more ways for our fund holders to continue to invest in Israel. JCF is here to help facilitate and simplify your philanthropy while enabling you to invest in Israel. If you have any questions or want further information, please feel free to approach me, Igor Musayev, our Associate Director of Financial and Investment Services, and Sue Dickman, our CEO, who are both here, along with my fellow esteemed board member, Michael Lustig. Thank you.
Thank you, Zoya and the Jewish Communal Fund. I'd like to invite our panel up on the stage. Joining us today is Harold Marcus, Michael Lustig, and Liz Michaels. I'll introduce each of them briefly, and then I'll ask them to say a few opening remarks here at the podium. Long before Isra and Itzhak was a twinkle in Stephen's eye, long before anyone was talking about socially responsible investing or values-based investing, there was Israel bonds. Harold served for over 30 years with the Development Corporation for Israel, or Israel Bonds, in the Pittsburgh office, and is currently the executive director of the Pennsylvania region, which also includes West Virginia, Delaware, and southern New Jersey. I think Israel Bonds surpassed over $1 billion last year, and 800 million of it came from Harold's region, so kol hakavod. 80 million came from Harold's region. 80 million. Michael Lustig. Michael claims he's retired after 25 years on Wall Street. Michael spent most of his time at BlackRock as a senior managing director overseeing structured mortgage and derivative products trading. He has a deep involvement in UJA-Federation of New York, and most relevant to today's discussion as chair of I4, which is all about impact investing, which I'll let him speak about. And finally, joining the panel is Liz Michaels. Liz is Aperio's Chief of Staff and Director of ESG/SRI. We'll get to that in a moment. Prior to joining Aperio, Liz was responsible for the $11 billion defined contribution managed account business at Ibbotson Associates. Liz will talk a little bit more about our new partnership with BlueStar and Aperio as it relates to pro-Israel global data set and portfolios. So, Harold, it's all yours.
Thank you, Joe. Good morning, everybody. It is really my honor to be here representing the Development Corporation for Israel, Israel Bonds, which has been my professional life for over 36 years. Israel has been selling bonds since 1951, the brainchild of David Ben-Gurion. We all know that he was a man small of stature, but great of vision. And he knew it would take capital for Israel to succeed. So he sent Golda Meir to Wall Street to try and have Wall Street underwrite the initial securities being offered. And probably the only time in its history that Wall Street agreed on anything, the answer was no. Why was it no? Because Wall Street did not believe Israel would live long enough to spend it, let alone pay it back. Undaunted, Golda Meir came to the United States and went through different Jewish communities, door to door, much like the Avon lady, to sell that first issue of bonds. She sold $50 million. Think about it, 1951, $50 million, bonds that were $50 and $75, and she sold 50. Why? Because she was selling to a generation that had just survived the horrors of the Holocaust. And she was selling to a generation that just had felt the labor pains of giving birth to the Jewish state. So it really was the original mission-driven investment, because the dividend wasn't in dollars and cents. The dividend was in the success and the survival of the state of Israel. And for many years, that's how bonds were sold. In the 80s, Israel looked around and thought, you know what? There's a sophisticated market out there. If we offered the right securities, we could greatly expand the program. And that's what happened. In the early 80s, the types of securities offered changed. And while we certainly to this day have not lost the mission-driven part of our investment, we now can compete as a financial instrument in almost any portfolio. As you heard Joe say, we passed the $1 billion mark. I think it's important to note that just 7 years ago, the United States was responsible for $600 million in sales. In the past 7 years, that amount has doubled. We just passed, as you heard, $1 billion for the fifth year in a row, and we are approaching $1.2 billion. So that's a 100% increase in the last 7 years. And we can get into reasons for that later. But probably the reason I was asked to represent bonds is I'm probably the senior member of the staff who remembers when we were only mission-based. And just as a little aside, when I first was interviewed for Israel Bonds, I was 30 years old, had 2 little kids, a new mortgage, had no idea what an Israel bond was. I had never heard of Israel bonds. My family didn't buy them. I walked away from that interview exhilarated, because how fortunate could I be to do something every day using the passion that I feel? So I like to say that while this has been a career that I never dreamed of, it's a career I always dreamed of, because my colleagues and I, and many of them are here in the room today, we get to every day come to work and sell our passion. And that's the way you're successful. And I think that's why Israel Bonds has been successful all these years, because it is a passionate, driven investment. Thank you.
Thank you, Harold. Michael.
So thank you, Joe, for that very kind introduction. I will say the one thing you left out is the thing that's probably keeping me very, very time busy these days, which is I'm teaching a class at NYU. And the reason why I mention that is because I'm going to get a little bit academic as I talk. Let's just start off and look at the world. What's going on today in the world? And the world is increasingly shifting towards mission-aligned investing and mission-aligned endowments. So if you look at the Ford Foundation, if you look at the Rockefeller Foundation, they are tilting their portfolios in their endowments towards things that align with their mission. And they're realizing that it doesn't make sense to operate as a foundation that's trying to do good in the world in different ways and have their investments move counter to that mission in some way. So they're very focused now on aligning mission and investment. And I'll take a little bit of a survey of the room. How many people here are donors to their local federation? Okay. You heard some examples from Joe of federations that are starting to tilt their endowments along with their mission. And I will greatly applaud Miami for doing so, because Alone has done an incredible job of getting Miami deeply aligned with their mission with respect to what they're doing with their endowment. But you'll be not too surprised to know that most federations are not necessarily aligned in terms of how they're investing their endowment with their mission. And if you look at the average federation, they are not invested in Israel. They may have some allocation to Israel bonds, and I would call that, version 1.0 of investing in Israel, but they're not doing version 2.0 and looking at things like ISRA and other equity or other types of investments that could be directed towards Israel. So we're not there yet. And the real problem, if you get to the bottom line, is kashrut. The problem is our federations are too kosher. And what do I mean by that? The investment and the endowment side of the equation is viewed as meat, and the grant making and committees that allocate funds are milk. And guess what? They're doing a very good job of keeping their dishes very separate. That's the problem. So there's massive resistance, there's massive ignorance on the part of the investment committees. They just, for the most part, do not want to cross the line. They don't want to do anything that's different. They don't want to do things that are necessarily off the radar of what they've been doing before. If it ain't broke, don't fix it. And I think one of the things that we have to try to do collectively is to try to break that logjam. So as you heard from my introduction, I'm chairing a committee at UJA-Federation of New York called I4, which originally stood for Impact Investing in Israel. I had 4 I's. I thought it was a cute way of doing it. But in actuality, impact investing is often looked at as the 4th sector after government, corporate, and philanthropic. And really, it's an amalgam of the 3 other sectors. And what I'm doing with this committee is trying to get the allocating committees at UJA oriented along impact investing in different ways. But at the same time, I've charged myself with trying to get the folks who think about the endowment to think Israel as part of their thought process. Israel, as you've heard all morning, is a very valid investment thesis. I'm going to quote Harry Heyer from before, where he said, Israel trades at a discount. And yes, that's true. If you look at the S&P 500 right now, today, it's at a PE of 25.8, just to go to the last decimal point. And the Israel, or let's say the Biggie index PE, is a little tougher to compute because we have some companies in there with negative earnings. But if you worked it out, you're still buying a cheaper dollar of earnings in Israel than you are in the US. So at bare minimum, given that we've had this 25% run-up in the S&P over the last year, that leaves some opportunity to shift some assets to Israel and essentially buy cheaper earnings there. So I would kind of make the case, and we'll discuss it in the panel, but I think that to the extent that you're looking at an institution that has an Israel focus as part of its mission, I think it's imperative and frankly obvious that they should be aligning the investment of their endowment along with that mission.
Thank you, Michael. Couldn't have said it better. Liz, please.
I'm going to change things up. I have some slides. And had I known we were going to talk about kosher, I would have relabeled this, sort of bringing a little kashrut into the endowment and the investment committee. So I think this is how I go. Let me start by quickly telling you about Aperio, because we're probably not all that familiar, many in your room. We're an investment manager located in Sausalito. And what is unique about us is we customize separately managed accounts for each and every one of our clients. So we're managing over 4,000 separately managed accounts, each of which are customized around tax, factors which some people refer to as smart beta, and relevant to this group is around values alignment. And so we have a lot of experience of the $22 billion that we manage, about $6 billion are in some form of values alignment and customized to each. And when we talk to our clients about how they want to align, we're looking at reflecting each and every client's unique value and mission. And we do that in a quantitative fashion. So this is where we bridge between the values that one side of the room might care about and the fiduciary responsibility that the investment does, because we quantify what's the trade-off between reflecting my values and the incremental risk that we take on. We are a quantitative manager. In most cases, our clients are looking to track a benchmark and minimizing the tracking error to that benchmark. So how do we think about that? Many of you who have been in the investment world or through business school have probably heard about the efficient frontier. Well, we co-opted it for our work in this space to help people understand the difference, the trade-offs between reflecting their values and the incremental risk. In our world, we measure that risk by something called tracking error, which for simplicity is simply how different do your returns look from the benchmark itself. And if anybody wants a statistics lesson later, be happy to do that over lunch. But on the vertical axis, we have the social score. And on the horizontal axis, we have this statistic called tracking error. And it's measured in basis points or a fraction of a percent. The more intense your values are reflected in your portfolio, the more risk you take. There's no right or wrong point along that red line. The question is, what feels right for you and your portfolio or the portfolio you're responsible for? So we went looking for a way of responding to our clients who were interested in reflecting their interest in Israel. Some of those were Jewish clients. Some of them were looking for a way to respond to the world as they saw it. And so as things happen in 6 degrees of separation, we connected with Stephen and BlueStar, and we were able to collaborate to bring a way of bringing more Israeliness into the portfolio. And so BlueStar created this pro-Israel universe. You've heard all the other panels talking about what's an Israeli company. And we had the good fortune of having BlueStar define that for us. And so we put the score on the left is the way we go about constructing these portfolios. Getting closer to 100 means you have more Israeliness. And closer to 0 means you have less. And so by BlueStar, they defined Israeli companies, things like Armat and Checkpoint, as being the most Israeli of all the companies in the world. And then we have companies with a major presence in Israel, and those are companies like Nielsen and Apple. And then companies with a material presence are companies like Estee Lauder and Under Armour. And Stephen and Joe and Josh would be happy to fill you in on the details of those definitions. But with that, we were able to say to our clients, we can overweight, we can tilt towards companies that have involvement in Israel. And so when we do that, as I mentioned, my red circles are a little off, apologies. We use this tracking error statistic. So what is the cost of tilting a global portfolio? This is the beta part of an investment strategy towards twice as much Israeliness as you could get if you just invested in an ACWI ETF, okay? And the answer is for 61 basis points, and that's 61 basis points, or 0.5% more or less, you can have twice as much exposure to Israel in your portfolio for less than 1% incremental risk in the portfolio, okay? And so that's how we go about quantifying this for our clients. Lastly, what we were aiming to do, we provide this menu, and I know you can't see that this is not intended to be an eye chart, but it is an idea, it's an opportunity when clients say to us, how do I customize our strategies? This is what we present them with. And then they can check off what they want, and you'll notice in the center, at the very bottom, the Israel exposure is there. So clients who are just interested in Israel can check that box. Clients who are concerned about environment and Israel can check those boxes. And so it allows people to express their values And then in turn, we quantify that to talk about what incremental risk is. And so that's been our very powerful partnership, and we are looking forward to bringing that in a kosher way to our clients.
Thank you all. So we purposefully gave you a spectrum, right? Starting with the base of Israel bonds, the iteration of adding Israel, being proactive in adding Israel to your portfolio, to a complete alignment of your values across your whole global universe, which is amazing. So I'll start out with a few questions, and I'm going to encourage us to open it up and have a dialogue, and then we'll feed you. Sound good? Okay. So we'll get the easy one out of the way, because this is as an investment professional, it seems natural to think that something that's driven by the heart, if you're motivated by something other than the highest return per unit of risk, or modern portfolio theory, then you must be giving something up. So I'm going to assume that you all disagree with that, right? Tell us why. Who wants to start?
I can start from a statistical standpoint. So this tracking error has been used for a long time. The risk models that allow you to define it tell you that over time, it's going to come out in the wash. So what tracking error does is it defines the ride you might be on. So with 1% tracking error, right, 2/3 of the time, if the equity returns 10%, you will be somewhere between 9 and 11%, roughly speaking. 90% of the time, you'll be somewhere between 8 and 12. 10% of the time, you have tail opportunities on either side of that. So it's neither a good nor a bad, but over time, you will revert to the mean and you will have benchmark returns. So you're going to take a little bit more of a ride, but for our clients, their experience have been, and our back testing has been, that there hasn't been a give up. And we don't have experience yet with the Israel one, but one that we have done a lot of work with is around fossil fuel divestment. And people assume that if you're out of oil, it's a bad. We looked back over several decades. Being out of oil actually worked to your advantage a little more than it did to be out of oil. So over time, it didn't matter. It all came out in the wash. But you were up 70 basis points over history if you were out of oil. So,
Michael?
I would say when you're looking at things like tracking error, you're looking at things based on statistical history of prices. I would say looking forward, as opposed to backward, if you will, I'll go back to what I said in my intro, which really harkens back to what a previous panel was talking about, which is simply that you're buying cheaper earnings. You're buying an asset that is undervalued on the whole, meaning if you look broadly at the Israeli market, you're buying cheaper earnings there than you're buying in the US. And I probably personally tend to have a value tilt to my own investing because I come from the bond world, and Israel is more of a growth market, I would say, on the whole. But by any metric that you're measuring Israel versus, and I'll keep it versus the US because that's what I know best, you're buying cheaper earnings. And if your portfolio has a very large US component and no Israel component, and you have an Israel component to your mission, then I can't see why you would not consider buying a cheaper asset in your portfolio that happens to also align with your mission. I went back to the heartstrings a little bit, but I kept it rooted in the value argument.
I think Israel bonds is unique in this regard, number of reasons. Number one, obviously, everyone we talk about diversification of portfolio. But we certainly have a segment of our investors who have absolutely no interest in what their return is. They're doing this as a mission-driven, and it's to help Israel. Then we have those who have those same feelings, but they're investing for their retirement funds or their children's college educations. So they need to know that they're getting the best return. One of the things that offsets anyone who thinks our rates are lower is the fact that, number one, in its history since 1951, Israel has never defaulted or been late with a single payment of principal or interest. So you can plan. You know what you've put in, you know what you're going to get out. That sometimes offsets the concern about what they're giving up. Then you have our institutional investors who invest, hundreds of millions of dollars in municipal funds and government funds who have to be convinced that it's a prudent investment. So they also look at the fact that there are no fees or commissions charged when you invest in Israel bonds. So that when you look from an institutional portfolio and you look at that return and you factor in what you would be paying if you were paying fees and commissions, it offsets a lot of that concern as well.
Thank you.
And I'll actually just add, just from the bond standpoint, if you look at Israel bonds as compared to other single A sovereigns, which is basically what it is, it compares very favorably on a yield basis. You're giving up liquidity because it's essentially buy and hold, but you're getting something that from a yield standpoint is comparable.
Yeah, and if I, piggybacking on what you were saying about investors aren't willing to give up, when you look at the impact investing world today and you look just right in this area where you have major Wall Street houses that have made a commitment to impact investing, they're not doing it out of their charitable side of the organization. This has been a market opportunity that they have seen, and they are comfortable getting into this space in fairly significant ways because they believe that at a minimum there's no give up for investors, and many are moving in the direction of believing there are opportunities there. And you see this as you watch the staffing, as Morgan Stanley has added people in its room, and you watch a Goldman buying Imprint. This is a thing, and it's because people believe that there isn't that give up that used to be assumed existed.
Yeah, and I'm sure when you implement these strategies, you change the relationship with your clients, right? Because you're talking about their values and you're talking about ways to mirror what's important to them in their portfolios. So it has an extra layer to it.
I would even say on that point, sorry to interrupt, basically what I'd say I'll speak with my federation hat on, what every federation is worried about is next generation. How do you engage the next generation? And guess what? You look at any poll of millennials, they care about values and things like socially responsible investing and impact investing. It all resonates with that generation more than anything else. And if we're trying to not be fossilized institutions and look forward to the future, and I want my kids to be as involved or more than I am, I have to make sure that our product, so to speak, is appealing to them. And this is directly in the wheelhouse of aligning it with our values, their values, and frankly, things that they care about.
Michael, you made a great case to the federations, and I spent 6 years at the Federation in San Francisco as the Chief Development Officer with the endowment and the campaign prior to joining BlueStar a year and a half ago. And when we talk about in a boardroom setting or with our donors, we talk about mission or values-based investing, everyone says, yeah, they nod their head. They say, that's a good idea. And then there's a gap, and that gap is implementation. So what are the barriers to, and I'll ask it for, across the line in terms of what are the barriers, you could start, Michael, to implementing something that connects your values to your portfolio in the communal setting?
Like I said, I think I kind of, blew the lead in my intro, but I think that there's really a disconnect between how I conveyed it as a kashrut thing, but you really do have a separation between the investment and the endowment management side of the equation, where their singular focus is maximize total return. And that's great, because if you maximize total return, you create ultimately more dollars to be spent on the philanthropic mission, which is perfect. But I don't think that we're necessarily sacrificing total return by including Israel as a component of a portfolio. As I said, I think there's a very valid and obvious, value proposition such that making Israel a component of your portfolio will help your returns. But I think the problem is, and I alluded to this before, is that people are very set in their ways, and there's very much the if it ain't broke, don't fix it. I think on a previous panel, Michael had said the classic quote about when people were looking at personal computers, you buy IBM because you can't be fired for buying IBM, which was old mindset. People over the age of 50 will get this, and if you're under 50, you won't. But that was a thing. So if you were a corporate purchasing manager, if you bought something with an IBM logo on it, you were guaranteed to not get fired for buying something that was crappy or perceived that way. So, but you may not have been the most innovative person in doing that. And I think that's frankly the mindset that's set amongst the folks sitting on many of these committees, which is we've been doing something a certain way forever, and we want to continue doing it that way because we know it works. And the fact is, if they open their minds a little bit more, there are other opportunities. And there are opportunities that, frankly, at the same time, are aligned with the mission. So not only is the grant-making side of the organization doing good, but guess what? The endowment can do good at the same time to its benefit on both a psychic level and a monetary level.
Thank you. You know, I may take prerogative and change the question a little bit for Harold. $1 billion of bonds, that's a lot of bonds. And I know a lot of folks historically have included in their portfolio, right? Maybe people generations older than me. So make the case, right? What's the benefit to Israel today to buying an Israel bond? How does that really connect to the mission and values?
There are obviously many benefits. First and foremost is that Israel bonds proceeds are used to develop every aspect of Israel's economy, so it benefits all of its citizens. That's number one. Number two, Israel bonds proceeds are an insurance policy for Israel. The slightest little blip in the markets across the world can cause a retraction in terms of what's available to Israel. So they know, number one, that Israel bonds proceeds will always be available. Number two, that they come unencumbered. Goes 4 days after you make your investment, your dollars are in Israel's treasury and being sent out to develop the economy. So those two things combined with the social statement it can make. BDS was mentioned before. One of our big pushes right now is a program to donate bonds to universities. Because as we look at the BDS movement on campus, as we look at our younger generation who want to run for student government, their loyalties are being questioned because of their Jewish identity. Buying a bond and donating it to university to fulfill your alumni pledge sends a huge message to the university and a mountain of support for the state of Israel. So you can use it. The benefits are great. It can be used personally, be used by the citizens of Israel. It can be used by what it means to the country to have more and more. Our government in D.C., Congress tells us time and time and time again, they gauge their support of Israel by our support of Israel. So if that's not a good enough motivation, I don't know what is.
Thank you. You know, you spoke of version 1.0, 2.0. Let's talk about 3.0, and I'll turn to Liz. You're on the cutting edge of building these values-based portfolios. What does 3.0 look like, or what does 4.0 look like? Where are we going?
Where are we going? So I think the first thing is where I think we are. And this piggybacks a little bit on what Michael said. The biggest change that I've noticed in the 6 or 7 years that I've been doing this are two things. One are the gatekeepers. 7 years ago, when that consultant was sitting in the room with the investment committee, the consultant was usually the one saying, this is kind of dumb. Donate the money and keep your investments sound, right? Like there was a tone deafness to that discussion. So even if the investment committee members were open to it, there was usually somebody on the other side saying, yeah, no, don't do this. And they would give all sorts of reasons, and the universities have been through this with the divestment campaign, and the numbers would add up, and it didn't make any sense. That has changed. As I mentioned before, every mainstream shop that I am aware of has especially if they're large, Cambridge Associates was mentioned earlier, they have a whole team of these people. So people are listening and more responsive. Whether they still think it's dumb or not is irrelevant. They're hearing it, and they are being responsive and providing solutions. That's the first. The second thing that has changed significantly, getting towards where we're going, is the asset owners themselves have started to stand up and say, find the solution for me. So 7 years ago, the consultant would say, this is dumb. And everybody would go, yeah, you know best. And everybody would go about their business, and they might grumble, and they might talk about it amongst themselves, but that was fine. That is no longer happening today. I mean, the biggest shift that we have seen are that asset owners are now empowered to say to their consultants, to their other committee members, this matters, and this is why it matters. Now we just have to figure out how to do it. And so that has created a whole different opportunity set, whether it's firms like ours or others you've heard from, in starting to build out products and solutions to help meet that demand. I think where we will end up is there will no longer be a conversation about this, right? Like right now you have these silos within firms. Some of them are more integrated than others, but you won't have a director of impact because impact will just be what it is. That'll be part of the investment thesis. And that proof point will have already been achieved. So I think I will be out of a job, and that'll be good for everybody.
Thank you. All right, we're going to shift to the audience here for a few minutes. I'm sure we've given you a little bit to think about. So questions in the back.
Hi, this is a question for Liz. The portfolios that you produce, how have they performed, the customized pro Israel portfolios, and do you optimize in order to select among the stocks in order to obtain a certain risk return profile?
So the answer to the first one is we don't know because we haven't done it yet. I mean, we're just starting. We just launched this about a month ago. In general, though, our customized portfolios have performed within their forecasted tracking error, and we have no reason to believe that the BlueStar and the Israel tilt will do any differently. So that's the first question. The second one was around, do we optimize in terms of what gets selected? Yes. So we have a universe of the data set that BlueStar provides us. The optimizer will then pick and choose among them to meet the risk exposures to reduce tracking error. One of the questions that came up early on, both internally and from folks we've talked to, is, well, it's just tech companies. And the fact is that that's not true. There's a heavy tech weighting, and it's not all just US. There is a global presence, and it is across sectors. So the optimizer is going to look, if it has a choice between a pharma company that has an Israel presence and a pharma company that doesn't, it's going to take the one with, is how it plays out.
Thank you. Down here in the front, Mr. I think it's Schoenfeld.
So you guys have described 1.0, 2.0. I'd like to ask a 2.5 to 3.0 kind of question to the collective wisdom of the panel. Most of the discussion has been on individuals or endowments. As you know, and Harold, you know this because it's been happening, there has been legislation in the public sphere against divestment or against BDS. And some public pension funds have even gone so far to increase their allocation to Israel bonds, partly connected to that, partly because it's a good investment. If you thought about all the states in the United States that have passed anti-BDS legislation, and if we could wave the magic wand and take a 2.0 or 2.5, 2.5 approach, how would public funds or municipal funds or university endowments that have no strong affiliation to Israel, how would they take some Israel bonds and go beyond? I'm looking mostly at Michael because Harold, we know what they've done with Israel bonds. They've invested, right?
So I kind of view, when I was doing 1.0 and 2.0, the 3.0 for me is really the next product area, which I would call, let's say, VCs and whatnot. So more private investments that are earlier stage, that have potentially more upside, but frankly a lot more risk and need a lot more careful curating with respect to getting into them and managing them. So I think the answer to your question, how to proliferate in both the 2.0 and 3.0 space, is to get more managers focused on the sector. And because, frankly, what do not only the endowments do, but all the state pension plans, they farm out to managers, like my old employer. So, and I indirectly managed a large quantity of pension plans, sovereign wealth funds, the whole gamut. But I think the way to get the word out, if you will, broadly, and to go into the 2.0 and 3.0 space for other constituencies is to get managers focused in that area. So getting managers to look at Israeli stocks as a sector on its own, and give it as an option like Aperio is doing, saying, okay, I think there's a value proposition here, I want to overweight this sector, this is how I can do it. And then to the extent that they have the infrastructure to handle looking at early stage investments and whatnot, building funds around that, because as we all know, there's a lot of opportunity there. There's some funds that have done well, there's some funds that have not done as well, just like in any other locale. And I think there's still a lot of opportunity there. So the right manager has a very good upside equation in front of them if they choose to go that route.
And I would say, you know, a little bit of the David and Goliath here, with all due respect to your previous employer, you know, we came out with this
Goliath
menu.
squared.
Yeah, exactly, and us. But what happened was, you know, for a BlackRock to get into something like this, there's got to be a large dollar amount there, right? Like scale matters. For us, it doesn't, we're little, right? So we don't need $1 billion to have a proof point to get somebody to give a go-ahead to do something. And so what we have seen, and we're really proud of this, we went into the divestment space and we said, it's possible, it can be done. We quantified it, and we did it at $1 million for folks, right? So all of a sudden, it became a possibility. And, you know, the state of New York isn't going to come to an Aperio to manage their money, right? But they will go to BlackRock, and now they can no longer say this can't be done. And so BlackRock did what BlackRock does and proliferated indexes and products and monetized the whole thing, which is great because it became a possibility. You know, we dealt with the relatively smaller world, and then you saw it go more retail. And then the BlackRocks and the State Streets and the Northerns went upstream. And so all of a sudden it became a possibility. And I really do believe on this Israel tilt that we're kind of the canary in the coal mine, mixing a whole bunch of metaphors, and it becomes a, well, why can't you do this for me? So we're not a black box. We're not a, this can't be done by anybody else. We sort of have seeded it in many respects, I think, in partnership with BlueStar.
Harold, do you want to add something?
Yeah, Steve, it's not as bleak as people may think. I think it's important to note that currently 37 states own and invest in Israel bonds. Some of them, like Pennsylvania, which has been buying since 1993 annually, are longtime friends. Others are brand new. In the past 3-4 years, their legislatures have actually had to pass laws to allow them to buy Israel bonds in states that aren't predominantly Jewish, that don't have a presence where that would be the introduction. So from our standpoint, we see the support, regardless of what you hear about legislation against supporting BDS or anti-Israel. The majority of states are very positive and very favorable and invest. In fact, we've taken state treasurers to Israel, and that opens the world to them.
I'm going to jump in and ask a leading, some people might say controversial question, connected. And so talk to me about what are the ethics around having investments in the portfolios of the organizations that everyone raised their hands on that may be contrary to their mission or values?
I don't think it's controversial. I think it's a softball question for me because I think that's insane.
But it happens.
It happens.
Describe what you're talking about.
Oh, so what Joe is referring to is, let's just say you were broadly invested in a world index, and you gave your manager a mandate, said, I want to own a world index. I'm putting 15% of my portfolio in some global equity index. And they're going to match what the global equity index looks like. And lo and behold, there are investments in what we might call bad actors. Objectively, as you know, living in the US and in an open democracy, you view them as bad actors. And from an Israel perspective, you'd view them as really bad actors. And lo and behold, they're going to have some little allocation in those bad actors because They're just trying to match the index, and without being terribly creative about that. beyond
Sorry,
that.
it might be Qatar, UAE, Malaysia, Indonesia, maybe Pakistan.
You got it.
Okay.
So, you know, a nice, a very good cast of bad actors, if you will. So, without even having intention to be invested in Qatar or in Pakistan, lo and behold, they have an allocation to that. And, you know, as I kind of said in my immediate reaction, I think that's kind of nuts, because if it's directly counter to your mission, I don't care what you think the returns are going to be, it just doesn't make any sense. So I can't see, I can see how it can happen. I can't see how it should consciously happen.
Can I make a data point to reinforce?
Yes,
what Michael
data
said?
point
Just a
acknowledged.
data point. No opinion here, but that same 60 to 90 billion of endowments that have some connection to the Jewish community or to Israel, collectively, have more money invested in those, just those 5 bad actors that Michael and Joe mentioned, than they do in Israel. It's just a data.
Thank you. Back to the audience. Questions in the back? Yes.
So as I understand, some federations are investing in Israel, others are not. If that's the case, consider that there was just the General Assembly of Jewish Federations of North America in LA. What is the position of the broader federation movement to get the less active federations more involved in Israel?
So the JFNA, which the GA is actually ending as we speak
Now.
basically, or if we were on LA time zone, they run an investment institute once every 2 years. And it was this past February was the most recent one. And both Stephen and I were on panels where we were kind of, to use the bad analogy for a Jewish thing, preaching the gospel on Israel investing in different forms. And it's given a side panel, but it's not given a main focus, and there's certainly no centralized directive. So the purpose of that biennial meeting, if you will, is really just to inform people and give people ideas and allow people to share ideas, but there's no centralized directive. So there's no JFNA, Jewish Federations of North America, won't send out a directive, you must do this, this, and this, or even we suggest doing this, this, and this. They'll just give you the tools and the resources to look at everything, and this is part of that broader toolbox. But there's no centralized directive or push in that area. And that's once again, I want to applaud Alon Ozer from Miami, and I can't see where you're sitting, but you're hiding. 15% is wonderful, wonderful. And you should feel proud, you should feel great. Everyone here should give them a pat on the back over lunch. It's really, I wish we could see that across the board.
I'll jump in and say, as someone who was at the GA for 24 hours and flew here last night to join you today, you know, you have to understand the federations in general, the movement itself is bottom up, meaning that every federation is local and is controlled by local politics, local leadership, and JFNA is there to help centralize and provide value on whole, right? So, and I'll acknowledge Joe Immerman, who's in the back, who spent many years at JFNA, helping to talk through these issues around the endowments and foundations and helping them to not only to look at Israel, but also to add value to the system. So, Joe, thank you for all that you've done. But it's not, you know, the reason I was there, and it was quite a crazy 24 hours, was that since it's local, I have to have a conversation with each and every local pro, local federation, local CFO, find their advisors, you piece it all together to affect change. And that's where we're at right now. Questions? Marla.
So clearly we've been talking all day that there's proven returns and there's a viable risk story. So I'm curious if hesitation is a discomfort with the perception of bias. And are we hypersensitive to protecting our values by overtly challenging them? And as nonprofit communities, are we afraid of accusations driven by anti-Semitism or backlash by donors?
I don't know who wants. I'll take it, I guess. There may be some of all of that feeding into it. And I'm not a psychologist, so I can't put myself in the mindset of people who don't necessarily agree with how I think things should be done. Obviously, I'm right. But aren't we all? But I think there may be some element of, oh, I don't want to bend over backwards because I don't want to do something that I guess we've all kind of alluded to, that I'm doing because I have an emotional attachment to it, and therefore, by definition, it must be inherently worse from an investment standpoint. The fact is it's not, and Alon will attest to the fact that Miami's getting great returns. And I think we all have to kind of get over that psychological hump of assuming that if it's something I care about, that means it can't be as good as something else, because I don't think that's true.
So I'll share a recent experience without naming any names, but within an endowment, within the governance, right, there is the group that focuses on mission and values in most organizations in some way, shape, or form. It can be the grant giving, it can be a lot of different ways that gets defined. And then there's the investment committee, and presumably the people on the investment committee have investment expertise and are there to make sure that their responsibility to its mission of growing the endowment, of grants, or whatever it is, can be executed. And so in a recent mandate that I had the privilege of working on, this organization split. They said, we are going to charge the values committee with defining what that profile looks like. What's our social profile? We know what our investment policy statement is, but what's our values policy? And we had the opportunity to work to help connect the dots between the data that's available and the kinds of values that they were expressing, of which Israel happened to be a part of. And then we took it, so we created a values policy statement that the values committee approved. And then our job was to translate that into an analysis similar to what I previewed here and present that to the investment committee. Entirely separate group, entirely separate type of expertise. The investment committee's job was not to second guess the values. They were simply looking at what's the tracking error budget, what amount of risk can we take, are we comfortable with the portfolio construction? And in fairly short order, because everybody's roles were clearly defined, they were able to bring it together, and we were able to avoid some of that constant back and forth with give up versus values in the way that this was approached. And it was kind of a poster child for how I think this can be done within a large organization.
Thank you. We're going to continue this. Alon, do you want to make a quick question or comment?
Just a quick remark. I want to say that. Thank you very much. Stand up. Stand up. I'm sure. I want to hear your voice. No, I wanted to say that we didn't decide on putting 50% in Israel. We just got there because we saw the opportunities. We had issues with sovereign debt. Most of the yields of some of the larger countries were negative. We got out of that. Or where am I going to put the money? Okay, Israel wants us a good holding place for now. But what happened was that Israel wants, for example, the allocation double. And some of it is short duration, so we can replace that as we see better opportunities. The other thing, like Michael said, the PE there's a big difference. By the way, if you take the PE of the S&P and you take out the negative PEs, you'll get a multiple of over 50. So I'm not sure it's the best comparison. But that's what we did. That's how we got to it. It wasn't mission aligned. We knew the product, we saw the opportunity, it's going to go below 15%. But that's how it works. That's how I think people should manage it.
Thank you. Last 60 seconds before lunch. Any quick action items you want to, when people go back to their desk tomorrow and they sit down, oh, that was a great conference. What should I be doing?
I'll share a success story.
Well, we don't have time. Sorry, we don't have time. I apologize.
This is
Okay,
a good,
very
it's a
quick.
good one.
Okay,
It'll be
go for
very
it.
short. We had an insurance company in Wilkes-Barre that bought $500,000 to $1 million annually. They were acquired by a major conglomeration, and that stopped. So after 3-4 years of hearing no, I decided I'm writing the CEO a letter. The CEO called me. That CEO was Warren Buffett. As a result of my reaching out to, I'm allowed to call him Warren because he told me I should call him by his first name, resulted in 2 events for bonds that raised $210 million. The bottom line is, when you have someone like Warren Buffett who invests in Israel privately, in terms of Iskar, which was his first foreign investment, in terms of his support of Israel bonds, in addition to what he buys through the company, he now buys personally. We can say to anybody and everybody, whether the investment is in Israel bonds or privately invested in some corporation in Israel, seems to me if it's good enough for Warren Buffett, it should be good enough for you.
Great.
Enough said.
Enough said. I'll add one thing. Ask the question, how much Israel is in our portfolios? And good things will happen. So thank you. Please join me in thanking Zoya, Harold, Michael, and Liz.
Because Pittsburgh's Federation